Non-farm payrolls are due out at 8:30 in the morning Eastern Time on Friday, July the 8th, and it's increasingly looking like it could be a fairly significant report because people are going to be looking for a confirmation or rejection of the surprisingly low non-farm payrolls that came out last month of 38,000, which was way below what the street was expecting. The street this time around is expecting 180,000 increase in jobs, and it's looking like that should be a fairly reasonable amount, maybe even a bit more. I suspect we could see a sizable upward revision to last month to the tune of 50,000 or so, based on the fact that there hasn't been any confirmation of the low payrolls number from anywhere else. Jobless claims have remained very low in the mid to high 200,000s, not only through May but again through June. Similarly, ADP payrolls were in the 170 area last month, 160 this month, and so we're definitely seeing that ADP payrolls have held up, jobless claims have stayed down, and the non-farm payrolls number from last month is looking more and more like an aberration or an outlier. So there's a good chance we'll see an upward revision to that, as well as a more solid report this time around. And the other question is, what does low job growth mean anyways? Some people had taken that to suggest it meant a slowing economy, and it was enough to put the Fed on hold at their last meeting. However, the other way to look at slowing job growth is the potential that it may also mean that the U.S. is getting close to full employment, and therefore you would expect, as you get close to the top, that the rate of growth would slow down. Where that also might show up is in the unemployment rate. Last month, the unemployment rate was 4.7%, and this month it's expected to once again to come in below 4.8%. The other thing to keep an eye on is if we are truly approaching full employment, we may see wages start to tick up. The street is expecting 2.7% growth in wages, up from 2.5% last month. If we are starting to see wage pressures build, would also be a confirmation that we're approaching full employment rather than a slowdown. So this is all important. Next thing, what does this mean for the markets? So far this week, the markets have been taking good economic news as good for the market and bad economic news as bad for the market. But bad also meaning dovish news. So has been soft on markets and undermining confidence, because it looks like we're moving into a period where we're getting pretty good U.S. growth, but at the same time, the Fed still, because of Brexit and other forces, is reluctant to pull the trigger on raising interest rates again. So if we continue to see this robust economy and a dovish Fed, would suggest the potential for a strong environment for corporate earnings. How are we seeing this play out in the markets? Let's look here at the minute chart. We had here at right at 8:15 in the morning back here. This first spike here was when the ADP payrolls came out, and then we had a second spike here when a second uplift here when the positive, much better than expected jobless claims came out. And on the two of those, look at this, we've just seen it ramp right up. Now we are getting a little bit of backing and filling here, but overall we've got the Dow trading in the green, and we've got positive momentum for stocks on the basis of this result. So if we get another positive result for non-farm payrolls, we could see the U.S. Stock market continue to improve. Another disappointment, however, we could see some of these gains get taken away and get knocked back, because again, people would start to think, what's wrong with the U.S. economy at that point. Looking here now, I'll also take a quick peek at the U.S. dollar index. And so here, similarly, we had I'll bring this out a little farther. So here at 8:30, we had a bit of an uptick. We've had it going down, and basically, U.S. dollar index has been trending sideways. Why? People are waiting for a confirmation of a non-farm payroll number to see which way things are going on Fed expectations. Here at 96, the U.S. dollar index is still pricing in 2 rate hikes this year. July could still be iffy because of some of the uncertainties going on in offshore, but and then September and October we have to wonder because of the U.S. election, and but there is still the possibility of at least one increase in December. If, however, if we see more pressures growing on the Fed to raise rates sooner, then I suspect the U.S. dollar index could trade flat to up slightly. If, on the other hand, we see another low number comes in and there's more reason for the Fed to stay dovish, we could see the U.S. dollar index come down as traders move towards shifting expectations towards one hike rather than 2 this year.